Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How you going?
I'm very good, Bryce. Excited to be back. The world never stops.
The world never stops.
Investing never stops. Investing never sleeps.
Feels like earnings season never sleeps.
Yep.
We're back into it, Q3.
It's easy to feel overwhelmed by the amount of information. I certainly do, trying to get some of it out on Instagram. God, there's a lot going on. But, hey, it gives us something to talk about.
Yes. Big episode today. We're going to kick it off with what we've learnt this week, then have a look at some of the results coming out of Q3 earnings. Checklist investing, what I picked up last week, building the investor checklist, or my investing checklist anyway, getting Ren's input, getting input from the community, getting input from experts. We're going to continue that journey.
Did you buy the book?
Haven't bought the book.
Okay.
There's a reason for that. And speaking of books, Ren, we're going to close out with a new segment that I'm excited for called Ren's Book Bonanza.
Yes,
You've got plenty of books in your wardrobe that you want to get rid of.
Well, they're not in my wardrobe. They're on a bookshelf.
Fair call.
I am moving house, or I have moved house, and way too many books to move. Like, you get attached to books that you really like,
Yeah.
but then they just sit in a bookshelf, and you move house, especially when you're renting, and it's like, I'm not going to read these again. They're just decorative, and they're heavy to move.
Yeah.
So instead, I'm going to give them out on the show.
Yeah.
And we'll talk about like what some of the ones that we like, what we learnt. But stay tuned.
I remember when I was a kid back in Wagga young, my parents had a big bookshelf with books from when they were young, the old school. Never read them. They never read them. It was just like that decorative thing. Then when we left, they downsized, moved, they just threw them all out.
Yeah.
So it's just
they
like,
should have had a podcast.
yeah,
and given them
it's
away.
just like, it's funny how you do hold on to books, but
yeah. No, you got to, I mean, like,
Anyway.
you know, you love the romantic idea of like having a study with like big bookshelves, but really all it would be is just my Kindle sitting on one shelf now.
All right, well, let's start with what we've learnt this week. Take it away.
So first thing for me is that there's always going to be another reason to panic. And the last couple of weeks, it's been the UK. You know, the tax cuts led to the British pound dropping, which put British government bonds in a precarious position. And then the British pension funds that had hedged their bond exposure all of a sudden had a solvency crisis, and everyone was like, is the British pension system about to collapse? 2 weeks later, bond yields are back down to where they were pre-Liz Truss's tax cuts. Everyone's like, the crisis is done. Well, at least the crisis of the moment has passed. And it's just such a reminder that there's always a crisis of the moment. Last year it was Evergrande and China property. The year before it was COVID. A couple of years before that it was European debt. Next year it might be Italian debt again, playing the hits. Like, there's just always something. And it's just a reminder that even when it feels like it could be chaotic, a lot of the times it doesn't matter, which is a bad place to be. It's like, it doesn't matter. But like,
I know what you mean.
Yeah.
Yeah. So we don't need to continue with the podcast.
Well, no, it's like what matters is individual companies and entrepreneurs and groups of people working on hard problems and trying to solve them and inventing new technologies and bringing them to market and solving people's wants and needs. Like, that's what matters.
Yeah.
As investors.
Of course, yeah.
Yeah, as consumers as well.
Have we seen the end of the UK crisis, though?
I think the pension solvency crisis, like Britain's in for a tough few months.
Yeah.
Inflation at 10.1%, energy shortage leading into winter. Who knows what's going on with their government? But yeah.
Energy shortage. I heard on the news last night that here in Australia we're expecting 56% increase in our energy prices over the next 6 months. Yeah.
That's not ideal. There is something very poetic about, and like this isn't a unique thought from me. Like, this has been said a lot, but there's something poetic about Rishi Sunak of Indian heritage now leading a country that, maybe one lifetime ago, the British ruled.
Yeah.
But it's even more poetic that Rishi Sunak is wealthier than the royal family.
I know.
Yeah.
It's ridiculous. £750 million
Yeah.
net worth.
Yeah, it's like, cop that, British.
Yeah. Well, his father-in-law
yeah,
is an Indian billionaire.
Co-founder of Infosys.
Yeah.
Yeah. His wife owns like a bit less than 1% of the company.
Yeah.
And
She has a
that's-
massive fashion label as well, apparently.
really?
Yeah.
I think that there's something very interesting in the way that we talk about Rishi Sunak and his wealth, and then the way we talk about like Mackenzie Bezos and her wealth, because they both married like money, or like, but we call Mackenzie lucky, we call Rishi Prime Minister, and I think there's something to that. Like, he was lucky, or calculated.
Yeah.
Yeah.
Yeah. Mackenzie didn't get married Bezos for cash, though.
No. But you know what I'm saying? Like,
Yeah.
they're divorced, she's a billionaire, and everyone is like, doesn't see it as legitimate or whatever.
Yeah.
It's like Rishi's money is less legitimate.
Yeah.
Mackenzie
I don't
was
see
at
his as
least Mackenzie was at least with Jeff
During
building
it.
during the
Yeah.
building and supporting, and
Yeah.
was probably deeply involved in Amazon, especially in those early days.
Yeah.
Rishi just married a billionaire. Like,
Yeah, it's fair call.
What? But BBC published a word cloud of Rishi, and the number one thing is rich.
Rich, yeah.
Should be rich wife.
Yeah, true.
Yeah.
Lucky,
It should be gold digger.
Lucky. Yeah, true. Oh, too funny. What else?
About Rishi, or
No, that you've learnt this week. Or anything
one
else.
other thing about Rishi that I found really interesting. I need to find my phone because there's a tweet, but it's worth finding. Hold on.
Okay.
So I think The Economist wrote something about when Rishi was competing with Liz Truss, and they said that in the UK, class matters more than race, and they thought that Rishi was going to win. They were wrong. But this tweet really sums it up, how much class matters in the UK. University education of UK Prime Ministers since the war, I assume World War II. Oxford, none. Oxford, none. Oxford, none. Oxford, Edinburgh. Oxford.
Great for marketing for Oxford.
Yeah.
Wow.
That's fascinating, don't you think?
Yeah. What would Australia be, I think, or America?
ANU.
You see. Charles Sturt. No offense to anyone.
No offense taken, I went to ANU.
Yeah, no, anyway.
You briefly went before you got kicked out.
I did, and then I went Armadale. But yeah, no, that is fascinating.
All right,
Class
enough about
matters.
Rishi. Rishi
Enough
mates?
about Rishi, yes.
All right, what did you learn this week?
A couple of things, very briefly. I was just interested in this. So the S&P 500, if you were in the index over the last 5 years, just index investing, market, just in the index, market cap weighted, 5-year return, 48%.
No, even with 2022?
Yeah.
That's a good reminder for everyone.
Yes. Yeah. Great reminder. 12-month return. The 1-year return. I'm talking like
12 months.
12 months to this day of recording, minus 15%.
Okay.
There's an ETF that's actually equal weighted S&P 500.
Nice.
QUS is the ticker. It's a BetaShares 1.
I think we told BetaShares to make that a few years ago.
Probably did.
I think you can probably check the tape with Alan.
Did.
Let's claim this one.
Probably did. If you're listening overseas, I'm sure there's
definitely
some equivalents overseas.
Equal weighted, just explain what that is compared to market cap weighted.
So market cap weighted means that the percentage holdings of the stocks in the index are based on how big their market cap is. So the biggest market cap has the highest percentage of the ETF. A equal weighted means that all 500 stocks have the same weighting in the ETF.
Mm-hmm. So an ASX 200 equal weight would be every company is 0.5% of the index.
Yeah.
And then a market cap weighted, if Commonwealth Bank is double the size of NAB, then Commonwealth Bank will be double the size of the holding.
Yeah,
in the
double
ETF.
the position size. Yeah. And so there's benefits and pros and cons for both. But I just wanted to have a look at what actually what difference it made. So the 5-year return for the market for the equal weight was 30%.
Okay, so less than 48%.
Less than 48%, because you're probably losing out on some of those top tech stocks that just ripped.
Yeah.
And you're getting a lot of the lower end 500. Not to say that they're not great companies. The flip, though, is the last 12 months, you're only down 1%.
Interesting.
So I think, without looking too much into it, but I would imagine that you're then not getting affected as much by the rout in tech stocks that have probably hit the top end of the 500. That's my guess.
Yeah. But economic theory would actually suggest it works the other way. Like, in theory, the lower end, like outside of the last 10 years where big tech has just dominated, in theory, the lower end of the S&P 500 are those mid caps that are growing a little bit quicker. And so the equal weighted one should grow more because they have more exposure to those smaller, faster growing names that are pushing their way up the S&P 500. But then in difficult times, they're the ones that get hit more because they're a bit more of a story. Their financials maybe aren't as solid. Their balance sheet maybe not as good. And then it's the market cap weighted one should be more defensive in a bad time because it's those like slow growing but rock solid companies that aren't as volatile. But it feels like the last 5 years, because of how tech dominated the S&P 500 is, that theory has been flipped on its head.
Yeah, it's fascinating.
So burn your textbooks.
Yeah. It got me thinking though. It's like long-term returns. I want to have a look at this. You know, what would equal weight be over 50 years versus market cap over 50? So I'll come.
There would be a lot of studies on that.
Yeah, so I'm going to come back next week with an update on that because, you know, we've been talking a lot about building the core, and you think if I had to choose between a market weight 500 or an equal weight, where would I be putting my money? I don't have an answer to that because based on the data, you can see that the upside based on the mix at the moment of stocks is you go market cap because you're in the tech, but the downside you protect it a bit. But what's that dynamic going to be over 40 or 50 years?
Yeah, fascinating. All right, well, I look forward to you coming back next week.
Remember.
So one thing that I said last week was that I'm going to start looking at my satellite and try and take advantage of this buying opportunity, the satellite part of my portfolio, look at some individual stocks. I ran a pretty simple filter on stocks that have fallen more than 40%.
Okay.
And there's all the obvious tech names, Zoom, Snapchat, Peloton. One that caught my eye that I wouldn't have expected to be down more than 40%, Nike.
Okay.
Like, you'd think big, defensive balance sheet, consumer staple, well, consumer discretionary, but like strong brand, global footprint. And so I was like, that's interesting. Had a look at their financials. So they've got about $144 billion market cap, $6 billion in profit. And so, like, very simple valuation metric, but 144 into 6. They're trading at like a 24 price to earnings at the moment, which just shows how hot they were.
Yeah, it still feels expensive.
Yeah. It's like at one stage they were trading at like a 40 price to earnings, a bit over 40. Like, that's like a growth stock.
Wow.
Yeah. So I was like, I think the story of the moment isn't for some of these companies. We're not at like the bargain basement yet. We're at the returning to long-term rationality.
Yeah. Well, I think that was the message that Julian McCormack was saying, right? When we interviewed him anyway, it was kind of like we'd chopped the tops off, but there was still at valuations that were quite inflated.
Julian McCormack's presentation at FinFest, which you can watch or listen to on our YouTube, was called "The Reaper Comes."
Yeah. He's
not impartial.
He's very bearish. He's very
quite
bearish. Yeah. Fair call. Well, it could be playing out.
Anyway, so if Nike falls another 40%, maybe I'll have a look. But
conclusion, still expensive.
Oh no, conclusion, just exploring my options.
Yeah,
you know, I'm like Bryce Lesky at 21 on Tinder, just exploring my options.
Not true. Nice.
You learn
nice.
anything else, or should we jump into earnings?
Just really quickly, and we were just talking about this off air, so I thought we should bring it up. You and I are both in the NAB Equity Builder,
Yes.
which is where you borrow money and you can invest it into the stock market, but it's structured as similar to a home loan.
We used to have to say not advice, but now that we're licensed, we can say not personal
Not
advice.
personal
We are not aware of your circumstances, but we will talk about this product generally.
Yes, yes. So just to give a quick recap, this is not margin lending in its purest form. The way that this works is you take out a loan and then you have fixed repayment and then there's a variable interest on top.
It's like a mortgage.
It's exactly like a mortgage.
And just like a mortgage, right now you could be deep in negative equity.
Yes, so there's no margin calls. There's nothing like that. You can just use your borrowing power to invest in the stock market, just like you can a mortgage. When we signed up a couple of years ago, interest rates were rock bottom, so it made sense. The average returns that we could have got just through dividends and those sorts of things were more than what we were paying in interest.
Yep.
So that made sense. The interest repayments are tax deductible, so there's a few things that go on there. But now we're seeing interest rates rise, and the interest that we're now paying on the equity builder is about 8%. That's the variables. That's the variable. It sort of varies.
Which the whole equation is if you're paying 2% interest and the stock market's returning 7% over a long period of time, then that 5% difference is worth it. 8% starts to put that maths into question.
Yeah, so it brings. It's an interesting dynamic though. Like in an environment of such high inflation, there is an argument that we're paying back the loan with less. The money's already gone to work.
That only works if we're getting paid more as well, doesn't it?
If we're getting paid more, but
Because
what I mean is
the value of the currency is decreasing, but if we're not,
but the money's already gone to work, right? We've already invested it.
yeah.
So we're paying. This is what I'm trying to work out. What's the best thing to do here? Like, how does it all play out with inflation ripping, interest rates up, but you've taken the loan at a lower amount? It's doing its magic.
Well, I feel like, and then you get into the whole, you're getting a bigger tax deduction as you pay more interest as well.
Yeah.
I feel like this is where it's like, all right,
Get
some
professional.
personal advice.
Yeah.
But I feel like if I was new to, like if I hadn't borrowed, I would now be like, I don't know if this makes sense.
100%. Yeah. At that interest rate.
Yeah.
You need a return.
Yeah. I guess we could sell and just take the equity out of it, couldn't we?
Yeah.
Yeah.
Yeah. If you've
Kind
made
of like a home loan.
if you've made money on it.
Yeah.
Yeah. Anyway, food for thought. But let's move on, Ren, to Q3 earnings, because there's been some big companies report this week. Some of the big tech names. So let's kick it off with.
There's way too many companies on this document for us to talk about now. So I think let's talk about a few and then head over to our Instagram because we're trying to keep up to date with all of them there. But Bryce, I want to start with this company, easily the most watched company for this reporting season, Meta.
Yep. Facebook. Instagram,
WhatsApp, Metaverse. We made a bet earlier this year when Meta may have been called Facebook then.
Don't know what you're talking about.
Had a market cap of 800 billion.
Mm-hmm.
And we can't actually remember if it was Meta won't reach $1 trillion market cap or $2 trillion market cap.
I think it was 2.
And I think we said we'd bet 10% of our shareholdings in equity mates. We probably get better case of beer.
Yeah. I'm going to... okay, keep going.
We made that. You said it would reach the trillion status.
Yes.
2 trillion status.
Whatever it was. Yeah, 1 or 2.
I said it wouldn't.
Yeah.
Very bold bet for me if it was at 800 billion and I said I wouldn't make
it. It must have been
trillion.
2.
Yeah.
Yeah.
It's now at 350 billion. It's fallen, what, more than half. How are you feeling about the bet?
I'm going to double down.
Really?
No. I'm going to cash out, I think.
Well, there's no cash out option. I'm not sports bet.
No, I mean, 2 trillion from here would be an incredible turnaround. Incredible turnaround story. Mark Zuckerberg would be going down in folklore as one of I mean, he does have a pretty good reputation for doing what he's done, but would go down as having pivoted the business, majorly pivoted for a second time now. And if his metaverse stuff does play out, to his credit, he's still plugging away.
Oh, he's definitely plugging away.
The market doesn't like what they're doing.
No, the scale to compare it to the like late 2000s desktop to mobile pivot, it's just like it's getting like apples and oranges at this point. It's like he took the same product and put it on a different operating system, different screen. And it was incredible. And he was early and he nailed the transition and it unlocked growth. But this is not taking Facebook and putting it on a different screen. This is just a completely different business.
Yeah. Well, that's why I say if he can pivot it, it would be amazing.
Here are some of their Q3 numbers.
Okay.
Daily active users, up 4%. Monthly active users, up 4%. Which just blows my mind when they've got like 2 or 3 billion users already.
Bots.
Yes. Frickin' bots. Ad impressions up 17%. Price per ad up 18%. Sounding pretty good so far. Buy?
No.
Revenue down 4%. Earnings before interest and tax down 46%. Net income, so profit, down 52%. They added 28% in headcount.
How is your price per ad up 18% and revenue down 4%?
Yeah, and your ad impressions up 17%.
Weird.
Maybe ad mix?
Maybe.
No, because price per ad is
price per ad, yeah. Unless there's another part of the business that contributes significantly more to revenue outside of advertising that they haven't done here, but
yeah, or unless our data source is wrong.
Yeah. Headcount up 28%, but they're about to cut a fair few, aren't they? 12,000 or something.
And then they've got 42 billion cash on the balance sheet. They're buying back $6.5 billion in stock. So there's like, there are definitely investors out there that are like, this stock is cheap. Strip out the metaverse stuff. Assume that a few years on, those costs will be gone, or I don't know, but like split it into a separate business.
Yeah.
Maybe you say the social media business seems cheap.
They flick out WhatsApp or they flick out Instagram. Yeah.
Or they flick out the metaverse. But then like, what's funding all that investment?
So at this stage, Ren, you win the bet. I'm happy to concede.
Really?
I'm not going to wait around for 2 trillion. Could be 20 years away. We'll need to make another bet by then.
Well, I'll take my case then.
Deal.
But let's move on. What's the company that's caught your eye this reporting season?
Well, Ren, this morning we had Google. Google was late last night, whenever it was. Yesterday.
We're releasing this episode a few days after this.
True.
Anyway.
Google came out and their price got pumped, down 9%.
Yeah.
Their share price. Off the back of slowing. And this is a theme that's kind of coming out.
Still growing.
But
slower.
But growing slower. And this is a theme that is coming out across some of the big tech companies.
Yeah. I think Google's 5th consecutive quarter of slower growth. Microsoft also, I think, slower growth. Well, I don't think. They did report slower growth. But Bryce, one thing that we've been speaking about a lot in the office, we've been speaking about a bit on The Dive, our sister podcast, another podcast that we host, is visual search.
Yeah.
And it is the biggest competitive threat to Google's business, as Google have said publicly. And Google are trying to get better at visual search. Have you used Google Lens?
No.
Neither have I. So this caught my eye in Sundar Pichai, who's Alphabet's CEO's, his earnings call. Quote, people now use Google Lens to answer more than 8 billion questions every month using just a photo or an image.
So is it just your classic, what tree is this? What dog is this? What?
I think so.
Or is it like, take a picture of a chair and I'm like, where can I buy this?
Both?
That would be cool.
Yeah. It is cool.
Where am I right now? Take a picture of, I don't know, the
Yourself.
street name.
Well, I mean,
guess you can just look at
I feel
Google
like
Maps.
Google Maps do that pretty well.
I'm just trying to think. When have I ever? I've never felt the need to use it. That's
Really?
my thing. Yeah.
Oh, dude, all the time.
Like what? What's an example?
I think I'm pretty sure there is an app that does this. Take a photo of a flower or a tree. What tree is this?
Okay,
Not that I'm wondering that a lot.
Yeah.
But like that's one that I've thought about. Take a photo of a celebrity. Who is this?
That's a good one.
What have they been in?
Yeah.
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 Something that I would love because I'm not great with faces and names. Take a photo of someone at a party. Who are they? How do I know them?
That's really cool.
Yeah,
you fake that. You're like, can we get a photo together?
Yeah, or that's when you put Google glasses on and it's like, oh, Bryce Lesky, I host a podcast with him. That's right.
So what does this mean for them though? Like, are they saying that this is where they're putting all their resources?
No. So the Google acknowledged that they're slowing down, and they said that they go through these periods of consolidation and slowing down and massive investment, and this is one period of massive investment. The last big investment cycle they went through was mobile, and they're saying this investment cycle is AI.
Yeah.
And I think Sundar Pichai in his earnings call said for the last 7 years we've been an AI company, and so that's where they see their future. And who am I to argue with them?
Yeah. Fascinating company. Fascinating. All right. Well, let's, any more that we want to touch on here, Ren? I think we can briefly say that we're starting to see some of the fast moving consumer good companies report, Coke and Pepsi. We know that last Q3, one of our big takeaways was to keep an eye on consumer discretionary and consumer staples to see if the flow and effect from inflation and interest rates comes through. The results from Coke seem pretty upbeat.
Yeah.
Given
Coke and Pepsi both
addictive products.
Yeah. Well,
People keeping them in their diet.
The thing you got to remember about both of those companies is they're big portfolios of brands. So they've got they got
pet food even. Coke.
Really?
Yeah, doesn't Coke own a whole bunch of pet food?
Maybe. You sure you're not thinking of Mars?
Maybe I am.
Anyway, you can feed Coke to your dog.
Maybe I'm thinking of Mars.
Mars is like a massive pet food company.
Must be.
Yeah. But
feed Coke to your dog.
but they both raised prices. I think Coke average price rise was about 7%. Pepsi also had a big price rise, but volumes didn't drop off precipitously. I think Coke even increased volumes 4%. And so what do we learn from that? It's that the consumer is willing to wear the price rise, at least at this point, which is a sign that a sign of one of two things. Either Coke is really addictive or the consumer is holding up okay. American Express had said something similar. They were like, we're seeing great spending across all categories. Yeah. So maybe the consumer's okay.
Well, if you look at travel companies as well, we're starting to see a few of the American Airlines and JetBlue as well report, and they're saying demand is sky high.
Yeah.
Pun intended.
This is not
travel.
This is not advice. This is not even general advice. It's just a thought. But like, I kind of feel like I want to take the contrarian position, and there's a lot of like the recession is coming, and the recession is probably already here, but the market always starts ticking up before the economy does. I actually have a number of charts about that I'll share on Instagram before this episode's released.
Nice.
It feels like there's maybe this is the time to take the contrarian bet.
What, short the market?
No, go long.
Go long.
Yeah. Anyway.
Aren't you going long every fortnight?
I am. Geared. One other company that caught my eye.
Yeah.
You know Netflix is up 70% from its lows?
Well played.
Yeah, so Netflix fell about, 75% earlier this year. It was getting smashed. It's up 70% from there. Just anyway, they estimate that they did the maths. Well, they've obviously got a dog in this fight and they're a bit biased, but they claim they did the maths and they said combined their competitors are losing $10 billion a year. So Disney, Amazon, blah, 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 on their streaming businesses, while Netflix are making a few billion in operating profits.
That's a great way to slander your competitors.
Yeah. They also released a chart which we probably shouldn't try and explain the chart. So maybe we'll also share this on Instagram. No, we'll share it on the forum.
Yeah.
They're really defending bingeable seasons, and they compare how they released Dharma, the serial killer show, against House of Dragon and Rings of Power. And they're basically saying releasing it all as a season is better still.
From engagement, from watch time. Yeah, I mean, I loved the Game of Thrones House of Dragon, and I did enjoy that it was once a week.
I kind of like it as well.
Yeah, because you just...
Although I didn't want to watch both of them at the same time, so I only watched Lord of the Rings, and now I can binge Rings of Power.
You definitely will.
Oh, no, so now I can binge House of Dragon. Yeah. And I'm keen to do that. Yeah.
Well, I mean, full credit to Netflix. They really battled it out. And I think, was it 3 or 4 weeks ago, they released their strategy on advertising, which the market obviously seemed to really appreciate. They were saying $6.99 for a subscription where you could then you'll also see ads but pay a cheaper subscription. Which we know the theory behind that is that it's going to broaden their market, addressable market to some economies around the world where they can offer a cheaper subscription. Yeah. All right, Ren, checklist investing. Last week I announced that I was building my own checklist, investing checklist, off the back of having spoken to plenty of investors who have said that it's a good idea. And this isn't by any means, I'm not going to get to the end and know that it's a good investment or not. It's just a checklist, tick box exercise.
Yeah. It's like
the start of the process,
and it's to ensure that you are thinking about the right things, to ensure you haven't missed anything.
Yeah.
To just to organize your thoughts.
Yes. So then we thought, okay, well, how about we read this book and we go and listen to that podcast and see what the experts have done. But I kind of felt that we've been doing this show for 5 years, that I want to have a crack at it myself.
Good.
Because I feel like if I'm still relying on, I want to prove that, we've learnt something. And when I get to the end of it and I feel like I've done what I feel is my investing checklist, then I'll consult others and kind of see, where have I missed? What have I missed? If that makes sense. So I'm going to have a crack at it myself. The second part was then when I went to do it, I was like, you know what? Like, given that sort of 80% of my investing is in ETFs, I probably should have an ETF checklist as well.
Okay, I like that.
And this probably applies more to some of the thematic ETFs, less so the core.
I mean, you could do it for core as well. Like, is it equal weight or market cap weighted? Is it the lowest cost option in the market?
Yeah, well, you're kind of jumping the gun.
Is the ETF provider reliable? Oh, sorry.
All right, segment over.
No, all right, sorry.
I'm going to start this one. This episode, I'm just going to chat about the ETF checklist because I probably did a bit more work on that because it's a little bit easier. And I've developed the 6 Ps. There's the 5 Ps in marketing.
I didn't know there were 5 Ps in
marketing.
Well,
there's the 6 Ps in the investing.
Do you know the 5 marketing Ps?
Price, position, product, place, and something else. I can't remember the 5th. But that's how you go through.
Cool.
Yeah, building them up. Anyway.
All right, ETF checklist.
So do you think I'm missing anything? Purpose of the ETF. Does it fit your investing strategy? Is it core or satellite? Does it make sense? What is the strategy of the ETF?
Yep.
Positions, aka holdings. I needed it to start with P. So do the holdings actually...
You could have said portfolio.
Good one.
Thanks, bro.
Do the holdings actually match the purpose of the ETF? Is the first one. If it says it's a carbon ETF or a cybersecurity, do those holdings in there actually deliver on? Yeah,
or if it's an electric vehicle ETF, and then you're getting exposure to like Ford and GM and stuff. It's like they're transitioning to electric vehicles, but they're not pure play electric vehicles.
Yes.
So is that actually the reason that I want to invest in
exactly? Is it what you want? Yeah. Second in holdings or portfolio is like concentration. Are you getting 1,700 stocks or are you getting 10?
Yeah. And
then also overlap.
Okay, so you've kind of put a few things in that one to keep the P theme, haven't you?
Yes.
Yeah.
Well, I think holdings or portfolio, does the positions in these portfolio overlap with ETFs I already have?
Yeah. It makes sense. And Yeah, yeah. Anyway,
So
keep going.
purpose, positions, price is obviously a massive one.
Yep.
Is this the cheapest option is where I would always start.
From a fee
From
perspective.
a fee perspective,
Yep.
is this the cheapest option? Yeah, I'm never looking at the price of the actual ETF.
So this is a bit of a tangent, so I probably won't take us down, but I've found an instance where the unit price of an ETF has kind of screwed me.
Really?
Yeah.
Keen
Do
to
we want to
know
go down
more.
that rabbit hole?
Yeah.
Rabbit hole? So with my auto investing, the Vanguard Asia X Japan ETF that I'm auto investing $100 into, its unit price is $60. The broker I'm with doesn't do fractional. So it's buying one unit for $61, and then it's just leaving the other $39 just is cash in my brokerage.
Dang.
Yeah,
I didn't
yeah.
think of that.
So the unit prices are going to screw with my equal weighting across the ETFs.
Damn.
Yeah.
You know that you could change brokers.
I could. Yeah, I could.
This is the beauty of being...
or I could, every second week just manually buy an extra unit.
Yeah, or now that... Yeah, or just... fuck, that's annoying. That is
Yeah.
really annoying.
Yeah.
Price. So firstly, is it the cheapest option? If it's not, why are you doing it?
Okay.
And I think we spoke about at the top of the show, equal weighted S&P 500 versus market cap. That's where you might look and say, I'm getting the exposure, but strategically I want equal weighted, so I'm prepared to pay a little bit more for it.
Mm-hmm.
But I don't think there'd be any other reason. You've got to be able to say, why am I paying for the more expensive if there are other options?
Yeah, or it's like if it's a thematic ETF and there's one where it's like a panel of electric vehicle experts are building the index and the other is just an index of car makers.
Yeah.
It's like, okay, well, this one's more interesting.
Yeah.
This feels like a better constructed index.
Yeah.
Yeah.
So then, this one doesn't matter so much to me, but I know that it does for some people. Provider. Is it one of the big ones?
I mean, it just matters in terms of like risk.
Yeah.
Yeah.
Yeah. It's very rare that you often find that the big providers tick all the boxes of everything above.
True.
So
Yeah.
cheapest, whatever. Past performance, worth checking.
Not an indicator of future
Not an
performance.
indicator of future performance, but definitely worth considering.
Yeah.
And then for thematics, it's prospects. And I say prospects because I couldn't say like growth or future. I
Okay.
needed a P.
Yeah.
But like, are you actually investing in something that from a thematic point of view makes sense for the next 5 or 10 years?
Yeah,
or is
yeah.
it just are you investing in the Donald Trump Twitter ETF? Like, does that really have future prospects compared to a hydrogen? Like, can you justify the future growth of this ETF if it's outside of your core?
Cool. One other thing that maybe fits under purpose, but and I'll give you a P for it. Plan.
Okay,
Does
7 Ps.
Does it align with your investing goals?
Yeah, I had that in purpose, but I
Okay.
see how you can...
Yeah. Because it's like, does this ETF fit my time horizon? Does it fit my risk profile? Like, is it something that fits how I want to invest and how
Investing
long I want to
goals.
invest for? Yeah.
Lifestyle. Yeah,
Yeah.
Nice. So that's where I'm at with my checklist. And
Cool.
I feel like that's a pretty straightforward, easy way to just, before you make that investment into an ETF, what I need to do here, though, is actually define the answers to those.
So why don't we say, now that we're licensed and we can talk about individual products, why don't you come back next week and give us a worked example?
Absolutely.
Maybe it doesn't have to be one that you're investing in. It could be one that you...
Yeah.
Yeah. And then we can actually critique how it goes and if we can think about if there's any gaps.
Okay. Love it. If you think, if you're listening at home and you think there's anything I should add to my checklist, jump in the forum, community.equitymates.com, leave us a note and we can jam out and discuss online.
Yeah, great.
Love that. I might put this up as well in the forum.
The 6 Ps.
Yeah, 6, now 7 if you're adding plan.
No, keep it in purpose
Okay.
I mean, it's your Ps, bro.
6 is a nice number. They say you should do everything in odds though, 3, 5s or 7.
Do they?
Yeah.
We buck the
Strategy.
trend.
All right. So, as I said, there is the checklist on the single stock side, but I'll pick that up when we get a bit more detail on my end. All right, Ren. So we're closing out the episode with a new segment, Alex Book Bonanza. As we said at the top, we've got.
It's so confusing that you literally introduced this segment. All right, Ren, and then you said Alex Book Bonanza.
Well, that's what you've written.
Yeah. Okay. Ren's Book Bonanza.
Ren's Book Bonanza. All right, talk us through it. How are we going to do this?
So, as I said, I'm moving house, and I've got a lot of investing books that I've read that I don't want to move with me, and I want to share them with the Equity Mates community.
So where are they at the moment then?
Well, some are in the old house.
Okay.
I actually took a box to the new house,
Okay.
but they'll be coming back.
Jeez.
And then some are in the office.
Okay, nice.
That probably sounded really loud on mic.
No, it's fine.
And so we've invented a bit of a game. I've got 3 books here. We'll talk about them in a second. And we've got Simon here who works with us. He's going to test the game out. Simon, how you going?
I'm good. Good morning, Bryce. Good morning, Ren.
Are you a bit
Hello,
nervous?
Simon.
Bryce is pretty good on the quizzes. So
Well, don't jump the gun. But as Simon said, we are doing a quiz. And so I've got 3 questions and 3 books. The rule of the game is simple. If Simon beats Bryce in the quiz, he chooses which book he takes home. If Bryce beats Simon, Simon still gets a book, but Bryce chooses which one it is.
Okay. And if no one gets it?
You guys would get it. Some of these questions are like closest to the pin. Like you're not going to know some of these things.
What? So it's best of 3.
Yeah.
Okay.
Yeah. And look, it's going to be really loose.
Let's go. You want to
Alright.
intro the books?
So the 3 books. The first one might look familiar. Hold it up to the camera if you're watching on YouTube. Get Started Investing. Simon, have you read it?
got a signed copy.
That wasn't a yes. Bryce is taking a photo of
I'm
me.
going to put it on socials. Pump the episode.
All right. The second book, Roger Montgomery's Valuable.
This is the one I want.
Have you read it?
I haven't read it, but I've heard a lot of good things. Recently on the forum, someone was speaking it up, and I've listened to him on the show a few times and really enjoyed the episodes. So this is the one I'm after.
Yeah, this is a cracker. You've read
It's
this
also
one.
quite rare, I've apparently.
Yeah, it's really hard to buy, and then sometimes it gets given away for free.
I've got 8 copies at home.
Have you read any of them?
Yeah, I've read it. I've read
8
it.
copies.
Yeah.
For me, so I don't know, you probably can't see this, but I'm holding it up. But he's got these valuation tables.
Yeah.
It was probably one of the most helpful books about thinking about valuing an individual stock for me. I really rate it. So this is number 2. And then number 3, this is one I also really rate, the Contrarian, book about Peter Thiel. You guys, Bryce is taking a photo. You're familiar with Peter Thiel?
Yes.
0 to 1.
0 to 1, the co-founder of PayPal,
Yeah.
co-founder of Palantir,
Yeah.
but also a massive funder of right-wing causes.
Yes.
If you're interested in tech, you should know about him. If you're interested in investing, you should know about him. If you're interested in US politics, you should know about him because some of the most high-profile Republican Senate candidates in this cycle, Blake Masters being one, who co-wrote 0 to 1, are basically being funded by Peter Thiel. And Peter Thiel, in many ways, is going to become one of the most important figures or funders of American politics. It's all in this book.
Can't
Cracking
say I've
read.
read it.
Pardon?
I have read that.
You have?
Yeah.
What did you think?
Thought it was a good book.
Yeah.
Not for everyone, but very interesting.
Okay, so Simon, of these 3 books, which one are you gunning for?
All good books, but Roger Montgomery is the one I want.
Okay, nice one. All right, well, let's get into the quiz. The theme of the quiz this week is big tech.
Okay.
All right, question 1. Which of these big tech players...
Hang on, are we buzzing in or are you directing?
Let's say... No, just both answer it.
Okay.
Buzzing will be annoying on mic.
So first in for this one?
Yeah.
Okay, yeah, sure, first in.
Alright.
Don't yell, though, because, again, that'll break
I'm gonna
people's
turn
ears.
I'm going to turn your mic down.
Okay.
Which of these big tech players has the highest price-to-earnings ratio? Alphabet, Microsoft, Tesla, or Amazon? Tesla, Simon has said. Bryce?
Amazon.
Bryce has gotten the ball.
Really?
Amazon has a price-to-earnings of 108.
Wow.
Tesla, it's been cut in half this year, price-to-earnings of 69. And a number that Elon's probably pretty happy with. Let's move on to question 2, Simon.
Damn.
You gotta win it you gotta get both of these. Apple's 4 biggest shareholders are the 3 ETF providers. So Vanguard, BlackRock, which is iShares, and State Street, which is SBDR, and Berkshire Hathaway. So the 3 ETF providers and Berkshire. Of those 4, who is the biggest shareholder?
Vanguard.
Simon, would you like to answer?
This is tough. Doesn't Buffett own like 20%?
I'm not going to give you the answer.
BlackRock.
BlackRock, unfortunately, Bryce is right again. Vanguard has 8% of Apple shares. Berkshire is second with a bit under 6. BlackRock
only 6.
has a bit over 4. State Street has a bit under 4.
Oh, it's miles off there.
If you're wondering why I'm leaning over the table like this, I'm playing Cheers when
For people...
when it gets it right.
Okay, just also be mindful that your head's in the YouTube. Guys, with his teething issues here. All right, final question. This is just for pride, Simon. Bryce is choosing
already.
your book.
True.
Which of these big tech players have had the worst year? Meta, Netflix, Spotify, or Tesla? Simon, you can answer first.
I'd say this one's between Meta and Spotify. I think I'm going to go with Meta.
All right, Bryce.
Meta, Spotify,
Netflix and Tesla.
Netflix, and Tesla. Spotify.
Bryce Lesky, take a bow. 3 from 3. I promise I didn't share these questions beforehand.
It's too good.
Simon, you were on the right track. Spotify, number 1, 60% down year to date. These numbers are as of recording. If Spotify blow the lights out in their report, then that might change. But Spotify down 60%, Meta down 59%.
Oh, it's close.
Netflix 51%, Tesla 44%. So Bryce Lesky, as the winner
Bryce, you've
of
schooled me.
the first ever Ren's Book Bonanza, you can kind of see them in the YouTube video. Which of these books will Simon be going home with?
Just got that. Well, look, given that Simon was here as the guinea pig for the show, for the segment, it is going to be the one that he was after, the one that he hasn't read, a rarity in the space. Get started investing.
Thanks, Bryce. Thank you.
No, we'll give him valuable.
There you go, Simon.
Give him valuable. Take it the Roger home. So Ren, the thing is here, we want to do this as many times as we can. You've got plenty of books to give away, so we're going to be jumping on the forum. We'll put something up on socials. We want the Equity Mates community to come and join us on this episode. We can call your mobile. As you saw, it takes only 7.5 minutes. So,
is that how long it took?
Yes.
We'll edit it down. But yeah, we'll put a post up. But if you want a free book, we'll post it out to you. We'll cover all that. And we'll just give you a call and you can play Ren's Book Bonanza.
Plenty to give away.
It's quite fun, even though I lost. This fun. So
nice.
get involved.
We'll use that as a testimonial. It's quite fun.
It's quite fun.
It'd be more fun if I won.
Well, that does bring us to the end of our episode today. Massive episode. Next week we'll be back. We've got a checklist to continue. I've got some stats around the performance of weighted versus market cap.
Yeah,
equal
you've
weighted
got a
versus
lot of
market
homework
cap.
this week.
I've got a lot of homework for next week. Earnings season will continue. Plenty happening. Also, stay tuned as we start to release more of the FinFest content as well.
Yes.
So we've got some awesome interviews coming up. Sown Hearts and Minds. Plenty happening here at Equity Mates. Otherwise, we'll pick it up next week, Ren.
Sounds good.
Thanks,
Thanks, Simon.
Investing. Everything you do learn is cumulative. What I learned at 20 is useful.